Good day everyone, my name is Romel Del Cristan Lawanza, and today I'll be talking about something that's part of our daily lives, managing money through loans, credit cards, and investments like stocks, bonds, and mutual funds. These topics might sound complicated, but they are really about learning how to be wise with our finance, whether it's borrowing money, buying something on credit, or growing our savings through investments. All of these teach us financial responsibility, something we all need as we grow older. What are consumer loans? Consumer loans are loans people take for personal, family, or household use. They help us buy important things like houses, car, or education, even if we don't have enough money right now. Let's start with consumer loans. These are the kinds of loans that people use for personal or household needs. For example, if your parents bought your family home through a housing loan, that's a consumer loan. It allows people to afford big purchases now and pay for them little by little over time. It's really helpful, but also teaches us responsibility because we need to pay it back with interest. Types of consumer loans. There are two types of consumer loans. Secured loans required collateral like a car or house. Unsecured loans, no collateral like credit cards or student loans. A secured loan means offer something valuable like your car or house as security for the loan. If you can't pay, the lender can take that item. Unsecured loans don't require any collateral. Examples are credit cards or student loans, but since there are more risk for the lender, the interest rates are usually higher. Credit cards. Credit cards lets you buy now and pay later. It's convenient, but must be used wisely to avoid debt. A credit card is actually a form of unsecured loan. When you use a credit card, you are borrowing money from the bank to pay for your purchases. The bank pays the store immediately, but you pay the bank later. If you pay the full amount on or before the due date, you won't be charged interest. That's called the grace period. But if you only pay the minimum amount or miss a payment, interest charge starts to build up. Credit cards are useful tools. They make transactions faster, safer, and more convenient. But they can also cause serious financial problems if not used wisely. Pros and cons of credit cards. Advantages. Easy to use, build credit, help in emergencies, may earn rewards. Disadvantages. High interest, overspending, and possible debt or fraud. Credit cards have both advantage and disadvantage. On the positive side, they are very convenient. No need to carry large amount of cash. They can help you build a credit history which is useful when you apply for future loans. Many cards even offer cashback, discounts, or travel points, and during emergencies, a credit card can be a real lifesaver. However, the disadvantages are always so serious because it's so easy to swipe. People often overspend and forget their borrowing money. Interest rates can reach more than 20% if you don't pay on time. Plus, there always the risk of fraud or identity theft. The best rule, spend only what you can pay back immediately. Understanding stocks. Stock represent ownership in a company. Common stock give voting rights. Preferred stock give fixed dividends. Now, let's talk about stocks, one of the most popular types of investments. When you buy a stock, you're actually buying a tiny piece of a company that makes you a shareholder, meaning you share in the company profits, even have voting rights in some cases. There are two main types of common stock which give you voting rights and variable dividends. Depending on company performance, and preferred stocks which offer fixed dividends but no voting rights. In simple terms, stocks are a way for ordinary people to grow their money, but they also carry risk. The company does well, you earn more. If it fails, you could lose money. Understanding bonds. Bonds like are lending money to a company or the government. They pay you back with interest after a certain period. A bond works like the opposite of a loan. Instead of borrowing money, you are the one lending it. When you buy a bond, you lend your money to a company or to the government. They promise to pay you interest regularly and return the full amount after a certain time. called the maturity date. Bonds are generally considered safer than stocks because the income is predictable. However, since they are less risky, the returns are also smaller. Investors often use bonds to balance out riskier investments like stocks. Understanding mutual funds. Mutual funds combine money from many investors to buy a mix of stocks and bonds managed by professionals for balance and safety. If you don't have time to research companies or analyze the stock market, mutual funds are a good choice. They are managed by professionals who combine money from many investors and invest it in different assets like stocks, bonds, and other securities. The idea is diversification, spreading your money across many investments to reduce risk. So even if one company performs badly, others in the fund may perform well, keeping your overall investment stable. Types of mutual funds. Stock fund, higher growth, higher risk. Bond fund, safer, steady income. Balance fund, a mix of both. Money market fund, short term and very safe. There are several kinds of mutual funds depending on your financial goals. A stock or equity fund focuses on company stocks. It has the potential for higher growth but also higher risk. A bond fund invests in government or corporate bonds. It's safer and gives steady income. A balance fund mixes both stocks and funds for moderate growth and lower risk. Finally, a money market fund invests in short-term loans and is the safest though it earns the less. The key is to choose a fund that matches your goal, whether you want to fast growth, steady income, or safety. Why this matters in real life. Understanding loans and investments help us make smart financial decisions. It's about using money wisely, not fearfully. All these financial tools are part of our real lives. Maybe your parents took a loan to buy your home, or maybe one day you'll use a credit card or starting investing. That's why financial literacy, or knowing how money works, is so important. It helps us make smart choices, avoid necessary debt, and plan for the future. When we understand the difference between good debt and bad debt and when to save or invest, we gain control over our financial future. Summary: consumer loans help people meet personal needs. Credit cards convenient but require responsibility. Stock, bonds, and mutual funds help grow money over time. Financial literacy key to stability and independence. To sum up everything, consumer loans and credit cards help us afford our needs, but they must be managed wisely. Investments like stocks, bonds, and mutual funds help our money grow. These financial tools can shape our future, but only if we understand how they work. That's why financial education is not just a subject in school. It's a life skills that help us become independent and secure. And that's the end of my presentation. I hope this gave you a clear understanding of how consumer loans, credit cards, and investment work. Remember, money itself isn't a goal, it's a tool. If we use wisely, it can help us build the life we can dream of. Thank you so much for listening, and may we all grow not just in knowledge but in financial wisdom.